You watch a company post a massive quarterly profit. You click buy, and the very next morning, your position goes into free fall. It defies logic. The revenue numbers were strong. Analysts on television praised the balance sheet. Your entire Twitter and Telegram feeds echoed the same instruction: buy. So you waited for the official earnings report. You wanted mathematical confirmation before putting your money on the line. Once the data proved the company was thriving, you finally felt safe enough to enter the trade. But the market didn't reward your patience. Instead, the stock price plummeted the moment your order filled. If the company is making more money, why are you losing yours? Relying on surface-level news creates an illusion of security. Waiting for the official data doesn't make a trade safe. It ensures you are the last person to enter it. The stock market does not react to past results. It prices in future expectations. This chart shows how an earnings surprise works. Imagine a company where analysts have projected a 30% increase in profit. The day arrives, and the company reports 20% growth. As a retail investor, you see 20% growth and consider it a solid performance. But the market only sees the missed expectation. The reality fell short of the projection, and that delta triggers an immediate sell-off. Even a perfect earnings beat can destroy a stock price if it comes with weak guidance. If a management team reports record-breaking numbers today, but warns that sales might slow down next quarter, institutional algorithms will instantly begin selling. The market operates as a forward-looking pricing engine. By the time a quarterly result is published, its value has already been extracted. The market functions as a transaction between early institutional buyers, the smart money, and late retail entries. This line graph maps the life cycle of a typical trade. Phase 1 is accumulation. Weeks before an earnings report, smart money starts quietly buying large positions. There are no headlines, and the price action remains flat, which keeps retail investors away. Phase 2 is the run-up. Rumors leak, and the price begins a slow, steady climb. A few speculators take notice and buy in, but the majority of the public continues to ignore the stock. Finally, we reach Phase 3, distribution. This is result day. The official release of excellent news hits the public, generating maximum FOMO. Retail investors flood the market with buy orders, desperate to get in on a proven winner. This is the mechanism of the trap. Smart money uses this massive spike in retail demand to quietly sell their accumulated shares into the incoming buy orders. On result day, retail investors aren't participating in a fresh breakout. They are funding the institutional exit strategy by serving as liquidity. To avoid entering during the distribution phase, you need a set of strict defensive filters. First, watch for the pre-result rally. If a stock's price has already surged significantly in the weeks leading up to the report, the good news is already priced in. Entering now means stepping directly into the path of selling institutions. Second, analyze the trading volume. If you see massive volume on result day, but the stock price is flat or dropping, that is not underlying strength. That is the footprint of heavy institutional selling. Third, listen to the guidance. Entering a trade based on phenomenal current numbers will still wipe out your capital if the outlook for the next quarter is unclear or negative. Never execute a fresh buy decision on result day itself. Use the data only to confirm an entry you planned weeks in advance, rather than letting the news cycle trigger a new one. If you've been caught in this cycle, your assessment of the company wasn't necessarily wrong. You simply executed your trade late. Surviving earnings season means ignoring the loud news cycle and tracking the quiet footprints of smart money instead. Next time, we'll cover exactly how to spot that early accumulation phase before the rest of the market catches on.